Hi, welcome to the Numbers That Matter podcast series. In this series I'll show you how to benchmark your business using the Australian Tax Office benchmarks and how to use them to find ways to improve your business. Before I start, let's go through some of the basics. So what is benchmarking? Benchmarking is when you measure the performance of your business against other businesses in your industry. We see benchmarking in sport all the time. They tell us this team is 7th in attack and 4th in defence and other sort of examples. It's the same in business. You're comparing certain aspects of your business against the industry standard. So if you were to check your wages against the industry standard, this may highlight that your wages are too high and that productivity is an area that you need to improve on. So why use the ATO benchmarks? Basically they are based on a large number of businesses in your industry, and this gives a lot of validity to the data. However, the number of ratios supplied is limited, so they don't give a broad view of how your business is doing compared to the industry. Therefore, you should not use this information in isolation, but part of a wider analysis into improving your business. So let's get started. For this podcast, I'll use a coffee shop as an example. Okay, to do this we're going to need two things. We're going to need the ATO industry benchmarks and also the spreadsheet that I developed to make things just a little bit easier. If you're watching this from my website, the links are down on the left hand side as you can see here. If you're watching this on YouTube, the links are in the box below. Okay, let's first start off by going to the ATO industry benchmarks. So because I'm doing a coffee shop, we are going to have a look at accommodation and food services, and then I go down and click on coffee shops. And there we go. Now if we go back to the other link and we go open the benchmarking spreadsheet, which I already have just to save a little bit of time, and there we enter only into the blue part. Outside I've protected it so you can't make any mistakes. So now if we go over to the ATO website, we'll have a look, and they've got the ratios split up into low, medium, high. So if your turnover is between 75 to 50, which it is in this case, you use the low column. So we'll use the cost of goods sold at 35 to 45%, and we're just going to enter over here under ATO benchmarks, 35 for the lower range and 45 for the higher range. Then we go back and look at labour is 7 to 21%, so we just enter 7 to 21%. And finally they give us rent, and that's 11 to 21%. Okay, so now we're going to get our own data, and so this is data that I've made up, and the sales are 114,400. The cost of goods sold is 37,752. The labour is 35,896, and the rent is 12,960. Now that we've entered in, down below we've got the results. So for the cost of goods sold on turnover, it's 33%, which is below the range being 35 to 45%, so this is a good sign. Labour on turnover is 31%, which is way out of the range where it's 7 to 21%. So this is an area that we would look at if this came up in a business. And one thing that I forgot to mention about the labour is that it's only labour for salary and wages for your employees. Do not include your own labour or the owners of the business. This is labour. So if we now have a look at rent, we're at 11%, so it's within the range, and it's the lower end of the range, so that means we're doing well in this aspect of the business. If it was around 18, 19, 21% at the higher range, even though it's still within the range, it's something else I would look at. Now let's move on to the most important part, the analysis. As I mentioned before, the ATO benchmarks are not comprehensive and should not be used in isolation to make decisions regarding your business. In this example, we will not look at each ratio separately. For coffee shops, it's important to consider wages and cost of goods sold together and not only separately. This is because how the shop has positioned itself will determine the percentages. For example, if the shop is selling more takeaway coffee, it may have a higher cost of goods sold and lower wages than a coffee shop that is attracting the lunchtime traffic and offering personalised service. This will lower cost of goods sold and give a higher wages percentage. So if we go back and have a look at our spreadsheet, cost of goods sold and labour together come to 64%. And if we compare the cost of goods sold and labour in the ATO benchmarks, 66% is the higher range. So we're up the higher range. So we need to look at either reducing one or ideally both of these to improve our business. Now, if we go back and we'll just have a look at the cost of goods sold. The cost of goods sold is exactly how it sounds. It's what it's cost you to purchase the goods that you sold. So in this example, the coffee shop, it's the coffee beans, the milk, the food, the cakes, all those sorts of things. So what are some ways that we can look to reduce it? First, most importantly, is to measure. So what is the cost of each product? So if you sell a ham and cheese sandwich, what does it cost you to make that sandwich? Is it one piece of ham, a piece of cheese, 2 slices of bread, some lettuce? Once you've worked out the cost of each product, you need to ensure that the product is made consistently the same, so that a ham sandwich always consists of 1 piece of ham, 1 piece of cheese. If someone is putting 2 pieces of ham on a sandwich and a piece of ham costs 50 cents, and that's happening 50% of the time, and there's 20 sandwiches being made a day, then 10 sandwiches are costing an extra 50 cents, so that's $5 a day. And over the course of a year, that's $1,250. Next, you need to check your pricing against those costs. So are you making as much as you think on each product? Or does the 80-20 rule apply in your business? That is, 80% of your profit comes from 20% of your products. Another way is just to measure waste. We manage what we measure, and so by measuring waste you may find you'll have better control over things. One slight little tip that you can do in a coffee shop is to highlight on the menu the high margin and the high turnover products. Just by simply highlighting it, people's eyes will be attracted to it and you may sell more of those products. Now let's move on to wages. Wages equals productivity. So a decrease in wages is an increase in productivity. So what are some areas that could be affecting productivity? Firstly, staff turnover. This can be a big issue. The longer the employee is with you, the more productive they should be. If you have high turnover, then you're losing productivity. Unmotivated or poorly trained staff. Do your staff have the proper training? Do they have the proper sales training to sell more coffees? Another one is poor scheduling, by having too many staff on at the wrong time. Let's move on to the last area, and rent. When it comes to rent in coffee shops, it's important to look at the percentage of revenue that rent absorbs and not the nominal amount. So $50,000 may be a lot for this business whose turnover is $114,000, but extremely cheap for a business whose turnover is $750,000. Another thing to do is to compare your location to the target market. Location is important to generating revenues and attracting your target market. If your rent percentage is too high and you're not a startup, you may need to consider if you are targeting the right customer in your current position. Benchmarks are a great way to help you work smarter in your business. They can give you great feedback on how you are performing and highlight the areas you can improve on to make your business a greater success. We include some benchmarking in our Numbers That Matter package. If you want to know how the Numbers That Matter package can improve your business, go to our website www.beyondthenumbers.com.au/services.html. That's all for this podcast. Thanks for watching. Until next time, goodbye.